3, 2, 1.
All right.
I missed the countdown. It's too busy playing the music, jamming out.
All right.
We were going to change this music, but I don't know. I've grown to like it.
I kind of like it.
Yeah.
Yeah.
It came with this mixer.
Consistency and yeah.
It came with the mixer, so we're not going to get like charged some crazy. That's happened to us years ago. We had another business. We put up like an ad that had a picture that we thought was covered with copyright. We paid for it, whatever. When we didn't. No. Anyway, we got fined like I don't know, it was $800 or something.
It was like $800.
Yeah, that was like 10 years ago.
I couldn't believe it. Right?
Yeah, so we don't want to play any music that's copywritten.
Right. Which is why if you saw the ad from this week on Facebook, the suave guy with a full head of hair and that fancy suit.
I thought he was a buddy of yours.
Yeah, no. It definitely wasn't me, I can tell you that.
No, it wasn't either one of us. I was jealous of his manly manes or whatever.
Yeah.
All right. Well, we got this week,
so
man. Let's get into it.
It's Christmas week.
It is Christmas week.
And what we got this week basically is this thing called the Santa Claus Rally.
Let's do it.
Yeah. Let's get on it. All right. So 27 December 2020 weekly update. The quote is from Yale Hirsch. Yale Hirsch founded the Stock Traders Almanac in 1967. Over the years, he's made a series of really important observations and coined a whole bunch of the phrases that are now pretty much part of market lore. Some of these phrases are the Santa Claus Rally, the January Barometer, the best 6-month strategy, also known as sell in May and go away and come back at Labor Day. If you want to see his work, go to stocktradersalmanac.com.
When are you going to start making up some of these snazzy little...
I think this is all in like posthumous things. Like, I don't know if you can make up these quotes and have people quote you while you're still around. I'm hoping I don't get quoted anytime soon.
Well, yeah, right. Maybe we'll get quoted in like another 50 years.
Yeah. I mean, Yale Hirsch, he found, I don't have, I think he died, but I'm not 100% sure, but his kid now runs the Stock Traders Almanac. He's been doing that since 1990.
Cool.
Yeah. So anyway, the quote, we're going to talk about both sides of the Santa Claus Rally, but if Santa Claus should fail to call, bears may come to Broad and Wall. So if you didn't know anything about the stock market and Wall Street and whatever, you wouldn't have any idea what that means.
No, I still don't know what it means.
You still don't know what it means? Okay. No, if Santa Claus should fail to call, meaning if he doesn't show up, fails to come calling.
But
right?
Call is an investment term.
It's what?
A call and a put? Like a
call. No. If he fails to come calling. Like if he fails to show up.
Okay.
Bears, which is the Bulls and the Bears may come to Broad and Wall. Broad Street and Wall Street is the corner in Manhattan where Wall Street is, where all the exchanges are.
Got it.
So if Santa Claus should fail to show up, a bear market may be coming to the stock market is the idea. Okay.
But he's going to come. Santa Claus is going to come.
We shall see.
Don't break my heart.
I
thought he's going to come.
Santa Claus is going to come. Whether or not the rally comes with him is a different. That's a different question. We're going to look at it. Okay. So before we get to that, the market this week, we had a shortened holiday trading week due to the Christmas holiday. Markets closed at 1 p.m. East Coast time on Christmas Eve. And because Christmas is on a Friday, markets don't reopen until Monday, the 28th of December. So, so it was a mixed week for the TSP funds. The C fund closed down actually 0.17%. S fund continues on its roll up 1.24%. I fund was down. That is not 0.50%. I missed a decimal point there. Yeah. I fund was down 0.5%. So 0.50%. And the F fund was up 0.20%. So we're going to talk about the Santa Claus Rally, and then we're going to look at the charts, and then we're going to call it a day.
Nice. Okay. I got a quick question before we get into that, just in case people don't watch the very end. If you guys think there's a member, this will be just for members because we won't be able to put this up outside of our... Well, maybe we will. I'll figure it out. If you guys think there's any value in having the PowerPoint deck, the slide deck that Jerry goes through when we do the show, let us know in the comments in this video, and we might try to figure out a way. I've been tinkering with that, but it does take a little bit, and it'll be one more step of the million things that we have to do on the weekend.
The Sunday list.
To get all this stuff up.
Yeah.
But, you know, it already exists, and I think we might be able to put it up. So anyway, if you guys are interested, say something in the comments, and I'll work on it. If nobody's interested in it, then we won't do it.
Yeah, good.
All right, cool.
That works. Okay. Santa Claus Rally. I'll give it an acronym, SCR. All right. So the Santa Claus Rally is defined as the last 5 trading days in December and the first 2 trading days in January. Okay, so 7 total days. This year, that is from December 24th through January 5th. So historically, stocks have done better during that 7-day period than any other 7-day period throughout the year. Okay, so according to one Oppenheimer study, since 1928, the S&P 500 C fund for us is up 78% of the time during that 7-day period. So the Santa Claus Rally is a real thing. 78% of the time, the S&P 500 is up, averaging a 1.7% return. So this is compared to any other 7-day period that you look at throughout the year. Any other 7-day period is only up on average 57% of the time, and the average rate of return is just 0.2%. So there's definitely something to this, right? It's not like flipping a coin. There's something to it. According to the same study, 6 months into the new year after a Santa Claus Rally, the S&P 500 is up on average 5.3%. So that's good. If we have a Santa Claus Rally, on average, we're going to have a bull market during at least the first 6 months of the following year.
Nice.
Okay. So I won't say plagiarized, but I stole some of that from J.C. Parrott at All Star Charts. So I got the link there, and if we get it in the show notes.
Great site to go check out if you're into technical
Yep.
analysis. He's great. And if you can afford his membership, you can afford ours, for sure.
He can probably make you more money, but it won't be in the TSP. I can
Yeah.
tell you that. Okay. So that's the good news. What's the bad news? What happens if there is no Santa Claus Rally? When Santa does not show, meaning when the market does not rally during that 7-day period, then over the next 6 months, the S&P is down on average 0.3%. Okay. So according to the Stock Traders Almanac, which was the Yale, what was his name? I can't remember. The guy that does the Stock Traders Almanac, which actually is where JC got the basis of the article that I sort of plagiarized from him. Anyway, according to the Stock Traders Almanac, Santa failed to show 6 times since 1994. So most of the time he shows up. It's only 6 times since 1994. So the odds are, following a Santa Claus Rally, the market goes up. But this does not happen 100% of the time. So it's stats, and we all know that stats can be made into anything we want. So if we look at the actual numbers, right, what does the Santa Claus Rally mean? Santa Claus Rally happens more often than not, which sort of seems to correlate with the yearly market moving higher more often than not, right? In bear markets, the market can be down for the year, even if it's preceded by a strong Santa Claus Rally. So if we look at 2001, for example, let's see. If you look at 2001 right there, we had a 5.7% Santa Claus Rally. That's huge. In 7 days, the market was up 5.7%. But the following year, it was down 13%, right? So it's an anomaly in a lot of ways, because if 78% of the time there's a Santa Claus Rally, and then if the majority of that time the following year is up, the following 6 months is up, this is a huge one-off from that. It's not the only one. It also happened in 2002. and 2018, which we're all probably a little bit more familiar with because it was a lot more recent. But 2018, we had the market tanked in October, went sideways in November, and then tanked again in December. But at the end of December, the very end of December, it came rocketing back up, and January 2019 was a huge move higher. So the actual Santa Claus rally, even though December 2018 was way down, that 7-day period, it was up 1.1%. But then 2019, we were down, not for the year, but that's 6.2%. So it doesn't always happen where if we have a Santa Claus rally, then we have a huge move the next year. But more often than not, it does. So what does that mean in terms of how we do technical analysis and all that? So for me, this is really good background, right? If we know that 78% of the time the Santa Claus rally is likely to happen. I mean, those are great odds in Vegas, right? 78%. What that does for me basically is, as I'm doing the technical analysis of the chart, all things being equal, which they never are, but if all things were equal, I might give the nudge to staying more in the stock funds during that period, right? Because I have this extra input that would maybe keep me in there longer, right? So I would throw, like, if you wanted to play the Santa Claus rally as a short-term little trading strategy, I would throw that in the bucket of market timing. Like, if you say, okay, I get it that the Santa Claus rally is real, it happens 78% of the time, I'm going to go all stock funds. I'm going to go 100% in, regardless of anything else, and hope that, I'm in one of the 78% years.
Right, because it's only one indicator, and we're probably going to look at some other ones.
Yeah, the next thing is going to be the chart.
Meaning current charts as opposed to historical, 78% of the time this happens.
Exactly. So I take that to again, if all things were equal, and I wasn't using technical analysis as like my primary, then I might just throw it in there and hope for the best. But that's not what I do. So a lot of people right now, I'm seeing this quite a bit on Facebook and an email. Why are we not back in the stock funds? Right. This is a short term. It's the 2 months where every tick is 30 minutes on the chart. On the C fund, the S&P 500. So what you basically see here we had this huge run up in November, right? And then we had this bullish triangle pattern that we talked about a couple of weeks ago. We had the breakout of that bullish triangle pattern. Now we have, so this is what they would call, Investors Business Daily would call this a base, this triangle pattern. Now we have another base, it's called a base on base. Okay? What I'm looking at is if the price popped up, let's say on Monday, right? So when the market opens next week on Monday, if the price opened like up here, I would be looking to get back in. If it opened down here, I would be very happy to be in the G fund. But right now we're in this range, right? Generally speaking, we're in this range. And
it's not really telling us anything either way.
It's not. I mean, it's in a sideways consolidation trading range.
It went through one.
Yeah.
And then now kind of popped up to another consolidation. Exactly.
So if you extended this line out a little bit, you can kind of see we got support there at 36.50, which was the high of this. It was the ceiling for here. We broke through it right there, right? And now it's the floor for this base. So it's base. It's base on top of base is the idea, right? So forget about the Santa Claus rally and all that. If I'm looking at this chart on any given day during the year, if you recall, we got into the market like back in here somewhere, into the stock funds. And then we got into the G fund like somewhere around there. I can't remember exactly, but it was somewhere around there. And so we had some good gains, but right now we're in this consolidation, and I don't really see a reason until we break the consolidation one way or another. If I were to get into the stock funds now, I'd be guessing, and I don't
guess.
I don't guess.
We don't guess.
Yeah.
We don't lose money.
Yeah. No, I don't want to lose money.
Rule.
Right.
Yeah.
So
your personal risk tolerance may be different. I mean, meaning someone else's, right?
Absolutely. There are plenty of people that are hitting me up saying, "Hey, why aren't we in?"
Yeah.
And what I'm trying to do with the short term.
Let's explain why we aren't in.
Yeah. Why we're not in. And so the worst possible case scenario, and it almost started happening today. At the end of the day today, you see this little. Let's see. You see that little last uptick? That's good because it means that there's some bulls out there. There are people at the end of the day that are buying it, which is great. There weren't enough to make it to push it above the prior high, right? This prior high right there. There weren't enough to get it up above that. That would have been helpful to get it out of this pattern. But the worst possible case is this. Because this pattern, right, sorry. Shoulder, head, shoulder, neck. This is the worst possible thing that we could get. The left shoulder, the head, and the right shoulder. Can you see that? Mm-hmm. So the shoulder on the left and the shoulder on the right now are the same levels. Okay? If the price rolls over and comes down and gets below the price comes down here, closes below that neckline, then technically this distance here would be that is the minimum that the price would fall to, somewhere around 3,500 at a minimum. So the worst case scenario right now is price rolls over and breaks the neckline, and then it comes down here. This is a really, I mean, it's if the head and shoulders pattern plays out, it'll be we'll talk about that specific pattern later, and it's a great pattern because if the price does roll over to here, it can still go higher because we would still be in this channel. But the head and shoulders pattern is a pretty good one. If it breaks the neckline, it definitely goes lower from there. So until we get back above, here's really the bottom line. Until we get back above that high, I'm staying in the G fund. And we don't have a lot of volume down here. So there's not a lot of buying at this point. It's close to Christmas, and I mean, that kind of makes sense, but there's not a lot of volume. So I'm kind of happy to stay where I am. So even though the market today was up 1/3 of a point, it doesn't take it out of the pattern for me, and so that's why I'm not moving.
And just to say it again for newcomers who, and I know people that watch this show all the time probably get tired of us saying the same things, but we have to because we get new watchers, new members, new viewers, new members. Anyway, if you're day trading, right, this is a whole different scenario.
Completely.
Because that chart, is going up and down. If you're able to come in and out, this is a whole different conversation.
Right.
Just people have to remember that when we're looking at these charts, it's TSP. It's 2 moves a month. It's closing a day's price, right? It doesn't matter what
noon,
it does.
Noon at that day's closing price.
You got to get it in by noon,
Yeah.
and then you get that closing day's price, which you don't even know at noon,
Right?
right?
It's very tough.
So there's a lot of things that go on as to why there's not enough data in that chart that we're looking at now.
Yep.
To make someone, at least for us, trying to manage risk as much as possible, why we're not in the stock funds. Right. So if you see that chatter on Facebook, there's the answer. There's nothing in that chart, right? There's nothing in the data that says, oh, be all in, be in there in the S and the C.
Right.
If you're day trading, whole different story.
Yeah, definitely.
We're not.
And if you wanted to just play the Santa Claus rally, you could, throw everything in there and hope for the best.
Jump in on Monday.
Sure. Yeah. Again, like we said before, if Monday opens up, 37. I don't know, 37.10 or whatever, that above that prior high, above the top of the head.
We're looking good.
Then we're in. Then hopefully we'd be in until the end of the Santa Claus rally.
Yeah.
Fine, great.
Yeah.
Great. Because and here's why. The odds of it rolling back over and going lower at that point decrease dramatically.
Yeah, significantly.
That's the point. Right.
All right.
Then we're not guessing. And then we have a place that, okay, if it got above that head.
We got a couple lines in the sand right now.
Yeah, that's right. That's all we're doing is drawing lines in the sand. Yeah. Okay. So that was the crux of what we're doing. Let's just go through the charts for the week. We've done plenty of longer term perspectives, and so we're just going to do the CS&I funds of the 6-month daily chart and take a look. So the C fund, we showed that sort of short-term trend line that we drew last week, the week before. This week, the C fund was really challenged to stay above the 10-day moving average and that short-term trend line. So if all goes well, we stay above that trend line and the market moves higher. But it won't take much to push it below that 10-day moving average and that trend line. So just be watching it, because it won't take a whole lot. And if it closes below the 10-day, it'll also close below the trend line. And then I'm already in the G fund, so I would recommend that's where you would want to be if we got down there. S fund's been killing it. Until the S fund closes below its 10-day moving average, if you're in the S fund now, I wouldn't sell it. Wouldn't think about selling it. I personally, if I didn't commit to this project we're doing and say that I'm gonna I'm not gonna make a move within my personal account unless I put it up to the group. If I would more likely be moving a little bit more between the funds and doing some other things. I'm trying to make it as simple as possible so that everybody can kind of get the idea. And
what we're doing here is for thousands of people at one time, as opposed to right. And that's another perspective that people have to remember, is that we might do this a little bit different if it was just nobody else. Right. But we're really doing it for the group.
Right. We see that on Facebook. Like, people are like, how can you get out of the S fund?
Right.
Well, because I went to All G because I'm trying to be consistent with what we're putting out.
Yeah.
Right.
Which for us, year over year plays out well.
It does.
And that's the long game, right?
Right.
It's the marathon, not the sprint. The other thing too is that we've talked about this. When we look at this chart, though, yes, it's a great time to be in S. It's also extremely risky.
It is.
Because you don't know when it's going to roll over, and if it rolls over afternoon on a day, who knows how much you're going to lose.
Yes, definitely.
How far is it going to fall before you can get out?
Right.
So, if I would say if I had been sitting in S for this long, maybe, I keep a nice eye on it during the Santa Claus rally, and then I take my gains and walk away, because it's going to, look at that chart, it's going to come down.
It is. And until it does, it hasn't.
Right. Until it does, it hasn't. And you know, based on our rules of having to get out, you know, at noon before the day
Right.
closed,
Right.
you know, that's just tough.
That's the thing. I mean,
tough.
right now, I mean, I haven't run the numbers, but you know, whatever the percentage is right now. So we're just over 2,000 on the index, and it's 1966. So whatever that percent moved down just to the 10-day, and then down to the 50, the blue line, you know, it's 200. So 1,800 is 10%. So it's a little bit. Let's say it's 11%, an 11% move or so down to the 50-day moving average, and it was down at the 50-day just, you know, just at the beginning of November. So it's historically the price spends more time, you know, the 10-day and the 50-day shouldn't be that far apart. Right now, the 10-day is 11% almost above the 50-day. Yeah. It's very extended. So for us, you're gonna, if the market rolls over, because you have to have it done by noon to get that day's closing price. So you potentially you're losing 2 days of losses. And if the S fund, you know, was to gap down on the first day and then collapse on the second day, you know, it's probably not going to drop 10% over 2 days, but it could drop 7 or 8% over 2 days.
Yeah.
You know.
Yeah. Yeah. It's just good to remember that if you're in the S, hey, good on you.
Yeah.
However, you better keep your eye on it.
Yeah.
Because
if it closes below that 10-day,
high market risk going on right now.
Yeah.
But good on you if you're in there.
Yeah, if you're in there, awesome, no doubt. Okay, iFund. iFund's always been strange and volatile, and you know, we had a I don't know if it's that Thursday or Friday, that day where it gapped down and then reversed and finished just below the 10-day. I mean, right now it's back up. It's regained its 10-day moving average line, which is awesome. The MACD, it's been rolling over. It's been negative and trending down since the end of November, even though prices have gone higher. So I would be very cautious in the iFund. I mean, I'm happy not to be there. It's just not a place I want to be, the iFund right now. We had a huge move the first couple of weeks in November and into December, but again, as long as it's above its 10-day moving average line, great, but it's too volatile for me. So that pretty much wraps it up. I wanted to throw out one other thing because a couple of people have been commenting about Brexit. So Brexit has been going on now for a couple of years, right? Yeah. Several years. Today, I think it was today, so Thursday, I put it up on Facebook this morning. The Brexit deal is done. And to be honest, I didn't even read the article. It doesn't, because in terms of what we're talking about, it doesn't really matter. The deal is done, and Brexit is going to go forward, and they figured out how to do it and all that. I had a bunch of people asking, what did I think would happen on the market when Brexit was finally signed? Because there was talk last week about it. Right. It was going to get signed this week. And it's another example of it's already baked in. Like, everybody knows the Brexit deal is going to get done. Mm-hmm. It's what you wanted to buy it way back when the idea of a Brexit was, you know, either buy it or sell it, whichever. But that's when you can make money, is when the rumor is happening. Yeah. When the news, which came out today, happened, nothing happened on the market because of Brexit. You know, it's the same kind of thing of what do you think will happen when Trump signs the stimulus bill? A bill is going to get passed. I mean, I know right now, today, as we're talking about it, there's a whole bunch of back and forth. Right. But it's already baked into the market. It's not like if he signs a bill, the market's going to take off. It's not going to happen. Right. It's already baked in. So
the news doesn't drive the market.
No, absolutely not.
The market drives the news.
The market drives the news.
But it does not.
It's a socioeconomic theory. Socioeconomics, if y'all want to Google that, the guy that does Elliott Wave.
I can't even spell it.
Actually, I'm sorry, socionomics. Socionomics. It's a new kind of, relatively new sort of economic science where the guy that runs the Elliott Wave newsletter has kind of created this idea of economics, the underlying behavior and stuff of societies is what drives things. Like, for example, there was a thing in the 20s where the level, and it still exists, it's one of the other stock market lore things, the length of women's skirts.
Yeah.
Have you ever heard of that?
Yeah.
It's the same idea, right?
Yeah.
If horror movies are the genre of the time, whatever,
Instead of like
it's a bear market. You're at the bottom.
Romantic comedies.
Yeah. It's weird. It's not weird. It actually makes sense if you look at it. It's behavioral economics.
Yeah.
You know. But anyway, by the time you get there, the market's already turned. So it's good stuff.
All right.
Anyway.
That's a good week. We've had, hopefully we have a good Santa Claus rally. Hopefully Santa Claus is good to you and all the people that are listening.
Yes.
And by the time this comes out, it will Christmas will be over. So I hope everybody has a good holiday. If you celebrate Christmas, hope you have a great Christmas. And we'll be getting ready for the new year, which I am extremely excited about.
Yeah.
I am ready to get into 2021. All right. Everybody have a good week, good weekend until we see you next time.
Sounds good. There we go. I like
We're
that
out of
music.
here.